recent developments in taxation of specified receipts under Section 56(2), including gift, share capital, forfeiture, termination, and valuation under Section 50(a). May I request Shri Salil Lodha, Secretary AIFTP West Zone, to escort our chairman for this session, Shri S K Poddar sir, to the dais. Requesting Shri Arvind Ramani of TPA to escort the speaker for this session, CA Pradip Kapasi, to the dais. Requesting all the other delegates to please take their seats on the dais.
NEC meeting is at 2 o'clock.
Taking this privilege of introducing the session chairman, Shri S K Poddar sir. Shri S K Poddar is a member of Supreme Court and a very senior advocate of Jharkhand High Court, Patna High Court and Jharkhand Income Tax Bar Association. Past president of AIFTP in 2012-2013. He has a number of professional associations. This president has taken AIFTP to new heights and motivated membership. With a great round of applause, please help me welcome Shri S K Poddar sir. The speaker for this session, CA Pradip Kapasi, is a chartered accountant and a law graduate. Leads a chartered accountancy firm, Pradip Kapasi and Company, located at Mumbai. He is the past president of the Bombay Chartered Accountants Society and the Chamber of Tax Consultants. He has co-authored many books and a regular contributor of articles in professional magazines and newspapers. He is on the editorial board of the Chamber's Journal. He was a lecturer and a visiting faculty at the Jamnalal Bajaj Institute of Management Studies on the subject of taxation for 12 years and at IIM on subject corporate taxation. He has received several awards for his professional contributions. Apart from profession, sir is a regular tracker and is engaged in social and charitable work. We are honored to have CA Pradip Kapasi at this juncture. We welcome you, sir. Inviting our chairman of this session, Shri S K Poddar sir, for his introductory remarks.
My very honored past President AIFTP, past presidents of the AIFTP, my seniors and honorable delegates. I was asked, oh, I'm rolling. People used to tell me, don't use bike, you can go. But friends, I'm actually not well for last few days. Pradip will vouchsafe, when I was talking to him yesterday, he could make out that I can't speak much. And therefore, he was good enough to say that Mr. Poddar, don't worry, I will take it up. You just tell me what I have to speak. I said, if I have to do that, then I will speak myself. So, you will speak whatever you feel like. But the important issue, according to me, in this 56(2)(7 is 2(7), which says that the purchaser is a deemed gift. The value difference is the deemed gift. If Mr. Badha and other permits me to say, I will just mention, according to me, this has been drafted by some person who never thought of what he is drafting, what is mean of. thousands of questions can arise that why a person has paid less than the price for the stamp duty. Why he has paid? There are so many things. There is a difference between this chair and this chair. So how you can say that this chair is the same thing and this chair is the same thing? Here are two chairs, in one in which I am sitting and in which very learned speaker Mr. Pradip is sitting. There is a big difference. The chair of Pradip is much higher than my chair right now. Because he will be talking to you, he will be sharing with you the thoughts and intelligence about the taxation law. And it is a very, very burning question about 56(2). And I also add one thing, with the permission of my past presidents and the president, that in our organization, when we discuss in the seminars, we should also resolve and we should also decide and communicate to the government that what should be done. What I mean to say is very simple, that if we feel that this section should be struck down, we must tell them that this section is useless. It should be struck down, as we have talked about the fringe benefit tax. And if you remember, it has been dropped. When Mr. Jaitley came as the finance minister, a welcome statement came from him that he abolished wealth tax. You may say that I am just making a departure from what I have to speak about, but I think I must say this thing. He made a departure to suggest that wealth tax is useless because we collect only 8,000 crores of rupees from wealth tax, and the entire total expenses are much more than what we are doing for the collection. Now this 56, how much you are collecting? You must weigh that what you are collecting, as we have been talking about the Kautilya and Chanakya all the time, that let us have the money from the taxpayers without pinching them. But here we have the money, not only pinching them by killing them. Therefore, this is very important, Mr. Pradeep, for you to suggest to the government even, through whatever you are discussing about, that these sections, which are virtually not giving any revenue to the government, only litigation and litigation and litigation. On one side, government says no litigations, on the other side, there are litigations. Therefore, we must discuss about it, we must think about it, and we must resolve. One thing more before I sit down, friends, I would like to say that I don't know where is the medicine. I am having medicine in my both pockets. But right now, the medicines is AIFPP. How AIFPP? As I mentioned, that it was roaring. Believe me, that I was not able to speak yesterday. Believe me, I slept today morning because I was not able to sleep yesterday night till 3 o'clock in the morning, since I was not feeling well. But being here, I think I can speak, I can roar, and I can talk some sense. Therefore, friends, the AIFTP is the best medicine so far I am concerned right now, and I hand over the mic to Mr. Pradeep for some sensible, intelligent, and thought-provoking talk, not a generalization talk, as I mentioned about it. Thank you very much, friends.
Over to you, sir.
Chairman of my session, very respected Mr. Poddar, my friends on the dais, my very respected seniors, the President, ladies and gentlemen, I'm extremely pleased to stand before you to be a part of some of the deliberations on a subject which is of a day-to-day importance, but it's also at the same time very, very complex also. And it's something all of us in practice do face. All of us is in appellate practice do face regularly, and therefore it's time that that a subject which otherwise, as the chairman rightly commented, is a matter of great nuisance and something which is yet to test the test of constitutionality before the courts. Before we discuss this, see, it is my bounden duty to be extremely thankful to the chairman for having made it, because in spite of his ill health, he is very right that his pockets are full of medicines. But then the medicine, see, which this conference would provide, would ensure that that he is healthy and hearty in a very, very short time. He has in a very short time, in nutshell, expressed his views about a subject which, as he said, that is a cunning issue, and therefore let's address. He has also expressed his desire that that I will talk sensibly. Frankly, I must tell you, and all of you are aware, that I am not known for talking sense. So let's see, with this little beginning, we are set about today to discuss something, see, which is primarily revolving around 56(2), and in particular some of the 3 or 4 provisions. In addition, we will also deal with section 50CA, which is a present addition, which has been made by the Finance Act 2017 with effect from AY 2018-19. And perhaps all of you must have had some occasion to deal with the obnoxious difficulties which one faces in the valuation of all these shares and the other properties. We will deal with that. This receipt of sum of money and properties, followed by the receipt of issue of shares for a consideration by a company, then receipt of interest on compensation. Then there is one very important thing, for some reason it has not been noticed, is the taxability of an amount which is received on a forfeiture of an advance. That also, time permitting, we will deal with, and we will end with 50CA. This is it. If you see, the main subject which we will be discussing today is a new provision which has come in the form of 56(2)(10), which is effective from AY 18-19 only, but has been there in different avatars, right from 56(2), 4, 5, 7, 7, 8, and thereafter now to the 10. So these provisions have been on the text since about more than a decade, and therefore I would not bother you with the mundane things of computation and such other things. However, in order to be comprehensive and complete, I have put all of what is available in the PowerPoint, but we'll touch upon, I'll have the permission from you all to touch upon only such issues which I believe are relevant, and if I miss something, you are welcome to put it up in the end in the question answer session. If I can summarize the whole journey, from 56(2)(4) to 56(2)(10, it's a journey which is spread over almost about 20 years. Way back in 1997, the then Finance Minister Yashwant Sinha introduced a provision somewhat similar to what we have present. And in 1998, after having legislated a provision, he had the clarity on the subject, and also he was charitable to drop the provisions, and by stating clearly that these provisions, in his opinion, were not in accordance with the Income Tax Act, and this perhaps is not the place where it should be placed. So, and therefore the provisions were deleted. The senior professionals from the Bombay, including me, we had an occasion to meet him in the year 1997 when this proposal to introduce these provisions was mooted by him. And at that time he was kind enough to give us an audience somewhere in Bombay only, near Sachivalaya. And when we presented that this provision is perhaps not the appropriate provision and you should not bring, and it will bring all kinds of rules and troubles for the taxpayers and also the government as well. And he was very diffident, like an ex-government officer, he was in favor of what he was doing, and he was holding his brief, and he was very well prepared also. He was saying that all these provisions of Gift Tax Act were being misused, and therefore there was a need to have a comprehensive provision to tax a receipt which otherwise is not taxable. And therefore when we thought that that the ground was lost and nothing much could be said about it, in the end one of the senior professionals, Mr. Narayan Verma, gave him a memento and also gave him a flower bouquet. And he said that all that what we wanted to say we have said. The last thing which we would want you to keep in mind, Mr. Verma told to Mr. Sinha that the last thing which we will want you to keep in mind is that what we have given you is taxable in your hands. And that is what really shocked him. That is that so? Am I introducing such kind of provisions that any and ordinary gifts also, given out of love and affection, in appreciation of personal qualities, for whatever you have been doing for the society, would also be brought to tax? And this is what perhaps I believe is made him realize that what he is introducing is something which is, as chairman said, was a nonsensical provision. And thereafter it was dropped. But 5 years down the line, the very same person who was then also the finance minister introduced a provision for the first time in the form of 5625. And since then the journey is persisting. And at times it's troubling also. There have been amendments which have been made simultaneously into subsection 24. As I said, constitutionality of this provision is yet to be tested. Given a choice, I would believe that such kind of a provision which seeks to tax something which is not an income at all, which even remotely could not be characterized as an income, is to be tested by the court. 50C has been tested by the court and it has withstood the stand of the court's inspection. But whether 56-210 or any of its earlier avatars would stand the test or not is yet for the seniors to tell us. With this, we would start with this. It is comprising primarily of 3 clauses. It has provisos, it has explanation, and it has rules also which have been prescribed for that. This is a code by itself, barring the penalty and collection provisions and the recovery provisions. It otherwise is a taxing provision. Read with 224, it becomes a code in itself. So with this, let's appreciate this. That basically what we are going to talk about as far as 56-10 is concerned, that it seeks to bring to tax 3 different kinds of receipts. When a person receives from any other person, first category is any sum of money without consideration, that would be taxed in your hands. Secondly, when a person receives any immovable property, when he receives any immovable property without consideration, or in this case for inadequate consideration, it would be taxed in your hands. Thirdly, if a person receives a property other than an immovable property, which is without consideration, or is it for inadequate consideration, it would be taxed in your hands. And the manner of taxation is being in detail thought of and is provided either by the section or otherwise by the rules. What is a property, what is an immovable property is also defined. What is any sum of money is not defined. But as I said, it otherwise is providing an exhaustive prescription. It goes beyond to say also that that I am listing down 10 receipts which would not be taxable in your hands. So it otherwise tells you that yes, these are the receipts in respect of which I would not tax you. These are the receipts in respect of which I will tax you. It is also having some magnanimity by telling you that if your receipts happen to be less than 50,000 in value, I will not tax you. So this is broadly the sum and substance of a charge which arises out of the main provision. An important thing is receipt, and receipt is something which is not defined. The important thing is consideration is again something which is not defined. So therefore I will take you through important aspects of that as the time unfolds. What is therefore we have learnt in few minutes is that there are about 5 charges. Each of them are independent of each other. There are 5 charges. One is any sum of money without consideration. Receipt of immobile property with and also for inadequate consideration, without and inadequate, and property other than immobile without consideration and for inadequate consideration. In applying these provisions, your residential status of a recipient is not relevant. If you happen to be otherwise receiving something which is capable of being taxed in India, then in that case your residential status loses importance. The place of receipt would be relevant only for a non-resident. A non-resident receiving some of the receipts which we discussed about in this country, then it might perhaps otherwise be taxable. But if a non-resident receiving something out of India would not be taxable. Likewise, if a resident is receiving something whether in India or outside India, it would always be taxed because he is exposed to the global taxation. So these are the factors which we would keep in mind. There is a threshold, that your place of receipt is relevant, your residential status otherwise is not relevant for the purposes of taxation as long as the receipt is otherwise taxable. There are computation provisions which are detailed provisions for each charge. These are the 5 charges. For each of it differently the computation is provided. Simply stated, when you receive something without consideration, the whole of it would be taxed. Simply stated, when you receive something without consideration, the whole of it would be taxed either on actual basis or on the fair market value basis, which is prescribed, whichever is higher. And that would be taxed in your hands. And in doing so, it would be determined whether the amount of receipt is more than 50,000, then the whole of it would be taxed. And for these purposes, without consideration receipts, everything would be aggregated other than immovable property for the claiming of the threshold exemption. But when it comes to the deemed gift, as Chairman rightly pointed out, is when something is purchased or acquired for an inadequate consideration, then in such case an exercise, a mathematical exercise will be carried out, whereunder you are first required to determine what is the fair market value, which would be the stamp duty value in respect of immobile properties. Thereafter you would deduct the consideration which has actually moved, you have paid for that. And if the balance appears to be more than 50,000 of rupees, then in such case the whole of it would be taxed, and it would be taxed at the maximum rate, that is 34%, assuming that your income otherwise is in that bracket. Your bracket is lower, then it will be taxed at that rate. What is important is now provided is after lots of representation over a period of years, in respect of, like Chairman said that 2 chairs are different, and I am very sure that his chair is much more powerful and much more intelligent than my chair. But then what is important here is that in an event if the what is transferred is an immovable property, then in that case a tolerance band like that of which is available in transfer pricing provisions of a 5%. But again the 5% of not of the fair market value, the tolerance band is of 5% of the consideration which is actually moving. So you will have to keep that in mind. So this is broadly the computation provisions. And last thing about computation is, which is usually missed, is that the threshold of 50,000 which is available is in respect of each of the transactions in immovable property. While in respect of movable properties and any sum of money, it is clubbed. Whole of it would be taxed. But in respect of immovable property, if you have received 10 properties, just a wild guess example, is if you have received 10 immovable properties and if each of them is less than 50,000, none of it will be taxed. That doesn't happen in this country, but just putting it. So now the charge. What are chargeable receipts? So any sum of money, it's very interesting to understand. And as it was pointed out by the judge Oka in the morning was that that it is the law, income tax is the law, which really sucks you into interpretation, which tells you that how fascinating the law of interpretation, the rules of interpretation are. And when you really see these 5 different charges, you realize for sure that as far as any sum of money is concerned, the charge is activated only when it is without consideration. The charge is activated in respect of receipt of any sum of money only when it is without consideration. Even if a minor or a negligible consideration was to move on account of your receipt, I would respectfully submit that in such cases the charge under that provision would fail. The charge under clause A of 56(2)(10) would fail. Because what has been charged and brought to receipt is something which is absolutely without consideration. Something all of you must have noticed, but I was fascinated, so therefore I am emphasizing this part. And to give you a clear example is that if I were to receive 10 lakhs of rupees, for releasing the rights in respect of a property whose worth above is otherwise 10 crores of rupees. What I have received is a monetary consideration. And therefore I would emphasize and beg to submit that in such cases that 9.90 crores cannot be brought to tax in my hands. It would be another story what would happen in the hands of other person. That's not something which we are presently discussing. So what I am emphasizing is that if you were to receive a cash, any sum of money, which is absolutely without consideration, you will be taxed. But if it is with some minor consideration, it would not be taxed. The other part, the next asset which we will deal with is, for which the charge is created is a property. And property is exhaustively defined. For some inexplicable reasons, it has been provided that property being capital assets, being the following capital assets of the assessee, we will take it up in detail because it's very interesting. So therefore, the next is that property being capital assets of the assessees, and then it is specified. And what is specified is first is land and building. What is, again in a very ambiguous manner it's defined, land, immovable property being land and building. At a first blush you would believe that immovable property is wide enough and something which is dealt with by the Transfer Property Act and General Clauses Act is the property which is sought to be covered. But when you see, all of you are veterans and you know about the complications which happen in 50C, 43CA about the interpretation of the word land and building. So it might have a narrower meaning, but presently we will rest our case at this place that what is covered is an immovable property being land and building. Thereafter there are movable properties, and movable properties are specified and exhaustively specified. What are they? Shares and securities, jewelry, archaeological collections, mind you, archaeological collections, not all types of collections, sculptures, drawings, paintings, works of art, and a later day addition because somebody in the government thought that jewelry may not include bullion, so it has been later on added. So what is bullion again is not defined. The scope is, what is important for all of us here is that the scope of this charge of 56(2)(7) or 56(2)(10) now is not restricted to gift simpliciter. It is much wider. It brings into its compass all kinds of receipts and not restricted to gifts alone. Originally one thought that it is in substitution of the Gift Tax Act. If that is so, then in such case the scope should have been restricted to gift tax. As the time would unfold, we will see that all kinds of receipts, everything and sundry, are sought to be taxed here if it is not taxed elsewhere. Income from other sources otherwise also was a residue we had, and therefore was wide enough to cover many things. Now within that you yet have another super provision which brings to tax any kinds of receipts. We'll discuss about it.
licenses, drawings will not be a capital, some sort of government sanctions, licenses.
If you
Because
permit me,
it has got a meaning of financial value.
I would request you to, bear with me for the reason that usually, I cover more than what is required. Yeah, so if you bear with me, I would have covered it somewhere. And in the end, if the chairman permits, we would have discussed it. Don't worry about it, right? Yeah, because the whole job is to discuss everything. But just bear with me. It will move with the flow, that's why. Yeah. Beyond residential status, yeah. So scope of what is this? A charge, we have understood that the charge is in respect of some specified receipts. What's the scope of it? See. When a person receives any of these chargeable properties, see, a charge is activated. When a person receives, so everything revolves around charge from any other person. So a receipt is very important. And unfortunately, the receipt is not defined at all. Normally, even when Income Tax Act is all about taxing income, Income Tax Act is all about taxing income, the legislature takes pain to tell you what is income in their mind. They keep on expanding it, but they do take pain. But when you create a fantastic charge like in 56.2, you don't tell what is a receipt. So therefore, what is a receipt? I don't know. So therefore, would you not be governed by what is the dictionary meaning or the ordinary meaning? And some of the things which one could just often think of is to possess, to hold, to acquire, to own, to receive, with obligation, without obligation, I don't know about it. But these are the classic cases of the ordinary receipt. So when a person possesses something, holds something, acquires something, owns something, receives something, and many more other things, there could be a charge, the scope of the charge, it may be within the scope of a charge. So I ask myself that is it really so that I receive something with a promise to return it to you tomorrow itself? Then in that case, would that be activated? And I feel that would be ridiculous. That perhaps could not be the intention, but that could be the intention, nobody knows about it. Unless you are specifically told about it. Unless some clarifications have been issued. And mind you, in 20 years, not a single clarification has been issued on this aspect of it. So therefore, I try to analyze, to try to make some sense of this receipt. So what is it? The first thing which I ask myself is that would it be alright if there is an obligation to return? Then in such case, this is not a receipt which should be taken. So it should be an unconditional receipt without any obligation. Perhaps there is a scope. It might fit into the scope. Will it be so that, now that you have a fantastic, all-pervasive charge, then in that case, even a capital receipt which otherwise you have been consistently told by judiciary over a period of 100 years that these receipts are not taxable, then in that case, such receipts also would get taxable. So that is another thing, I ask myself. So I try to rationalize that something which otherwise would not be taxable, let's see about it in detail. Then there would be receipts which are per se exempt, which are exempt by the provisions of Income Tax Act. Will there be a charge, or would there first be a charge, it will fit into the scope, and thereafter the exemption would be enjoyed? Is again an open issue. Then I receive certain loans which are interest free, I receive certain properties which are rent free, in such cases whether the charge would be activated or not. So one will have to go into these finer aspects and move beyond the mundane of just looking around the gifts and for its taxability, because these are the provisions which are taking you into deep and serious waters, maybe today or not tomorrow. Like what's happening, 28 is expanding every year. Similarly, 224 is expanding every year, and 56.2 is also on the similar lines. You will have to think about it. So what finally we all come here to conclude something. So I thought, let me share with you, some of the factors which according to me are decisive. So what I thought of was, the first thing I would test is that whether what I have received is without consideration or not. If it is for some consideration, then I will have to see whether this is applicable or not. So if it is without consideration, it might perhaps fit into the scope of it. So it would be essential to understand what is consideration for the purposes of our taxation. Then the next following question is a natural follow-up is whether it is inadequate. We'll discuss this. Whether I have a right to appropriate. If the money which you have given me, I can go and spend and make party out of it, then I have a right of appropriation. Do I have it? If I have it, perhaps it might fit into the scope, so I might have to say. Do I have the right of disposal in whatever manner? These are the factors which I felt would be relevant in order to decide whether it fits into the scope of this. Then in addition, now you have yet another amendment in section 68, which shifts the onus, on the person in whose account the amounts are credited. Now in such cases, there is a parallel charge under 56(2)(10), as also in 68, that also is something which one has to be careful about it. Lastly, in defining the scope, do I have to ensure that for a receipt it to be taxed in my hands, there should have been also a payer, a giver. A receipt by itself, should it be a two-way traffic? Should there be at least two persons before a receipt could be brought to tax? For example, if a person who has to collect money from me has waived his right to recover the money, then in such case, could it be said that I have received something? Maybe he has waived something, but could I be said to have received something? Under the provisions of Gift Tax Act, wherein there was an artificial deeming fiction of gift, in such cases it was a different story. But in 56(2), when you do not define gift, do not define receipt, there is a possibility of holding that a waiver by itself would not be a receipt in the hands of the recipient. These are just few thoughts. Then I am putting few examples, which will be revealing to you that what kind of a charge and what is the scope of it is there. I have lent money to somebody, and that man gives me the refund of that money. It's a receipt in my hands. It's a receipt in my hands. If you read it plainly, you will have to think at least. It may be that your assessing officer is bestowed with wisdom not to bring to tax such things, but it otherwise is a receipt. Then I receive something on distribution. There is a dissolution taking place. A better case is that I am a beneficiary of a trust and the trustees are kind to give me something. It's a receipt in my hands. It might be a receipt which has already been taxed also. I am receiving something from my partnership firm wherein I am entitled to receive something which is already taxed, but it is a receipt in my hands for which there is no exemption specifically provided. These are just to titillate your manner, thought process. A business receipt is also a receipt. Famously, presently in Shah Rukh Khan's case, he was asked that, this is a business receipt, why should it not be taxed? And provisions of 56(2)(7) were specifically examined in his case to hold that, 56(2)(7) came in much later. That's a different story, not stating clearly that this cannot be taxed under 56(2)(7). Then there are exempt receipts, which are otherwise not taxable at all, but they are still receipts. Then there are capital receipts. You receive something by way of a capital. Would it be taxable? Because if a gift is taxable, the classic case is our admission, a tacit consent to offer the gift for the purposes of taxation, admits that all kinds of capital receipt, unless exempted, is taxable. So this also we have to. Then there are grants and subsidies. Now there is 224(18) which is specifically enacted with effect from 1718, which brings to tax these grants and subsidies unless they are in the nature of capital acquisition related. So then insurance claims, it could be from the life insurance, it could be in respect of accident, it could be in respect of fire and general. So this we have compensation and damages we need to take care of. Then whether gross payments are to be taxed or net payments are to be taxed, receipts are to be taxed. There would be gifts in kind of unspecified movables which are not specified in the definition of property. Then there would be articles and things that we understand because they are specified. But there could be, things which are non-goods like IPRs and such other things. In such cases, what would be the charge or the scope? Then there are deemed gifts. Inadequate consideration are the classic cases of deemed gifts. There is also a lurking danger over that of application of section 9. Section 9 you would see that brings to tax deemed receipts and deemed income in India. Those are not otherwise taxable. They are not within the scope of section 5, but they extend the scope of. So one view would be that section 9 has to be also read with 56.2, read with section 5. The other view is that deeming fiction cannot apply to 56.2 because it deals with classic case of receipts and pure receipts and not deemed income. But when you see inadequate consideration issues are covered, there is a fear that even these deemed gifts could be included. When I have taken something on credit and thereafter I make, I make the payment, will it be a receipt in the hands of the permissions? And lastly, will deductions under 56 to 59 would be possible or not? So this is. Now there have been some cases, because finally, the sensible thing would be to, discuss and place before you something which has been addressed to by the courts. And there are several decisions, one after another I'll just place before you and leave it to your wisdom to decide what is the correct provision. And if you ask me, I'll share my view also on that is. So what's understood is that, if there have been transactions which were pre-amended transactions, which were initiated prior to amendment but which are concluded post-amendment, then in such case the courts are consistently holding that in such case that receipt would not come within the ambit of the amendment, which is a correct position in law. Then in loans and advances, different issues. Some power of attorney holder is made a payment to acquire something as an attorney on behalf of the principal. Then there is an employee who has been given interest-free loan for acquiring some property for his residence. Then a simple loan is given to somebody. Then a financial institution is granting me a loan. The assessing officer has an audacity to say that this is taxable because it is not coupled with an obligation to return. It is not coupled with an obligation to return, and you have not laid evidences to demonstrate that it is a refundable loan. Now this is the, why all this is being placed to you is this is the kind of stretch which these provisions enjoy when it is being implemented by the officers. Fortunately, all of the last is that of an agent who worked on behalf of some principal. In his hands also it was sought to be taxed. These are the cases, fortunately all of them without exception had no hesitation in holding that this is for a consideration, though this is a receipt, it is for a consideration. In some cases they said it came with obligation to return. In some cases they said that though we cannot find why it should not be taxable, but we are holding that it should not be taxable. That is all very pleasing. So therefore, in such circumstances, we need to, these are the cases wherein receipt and consideration, both of them were examined, but what would be individually receipt we'll see later on. What would be independently consideration we will see later on. Now this is later on, it is a case of receipt of any sum of money. A lady receives a sum for her maintenance on partition of an HUF. The assessing officer wants to tax it. Fortunately, the tribunal stated that sorry, you cannot do so. But such are the things. Supreme Court way back in the context of 80G had an occasion to examine that what is the true meaning of any sum of money. Why this is relevant is, it is the same terminology which is being used in 56 to 10. That what is any sum of money. And the case in Ravi Varma's case, Rama Varma's case was, facts in that case was that the person had given some donation by fine and had claimed 80G in itself. The Supreme Court then famously said that it is not something which has been paid by way of money and therefore you would not be eligible for deduction. Using the same terminology, I would hold that that any sum of money would not include therefore any receipt in kind. So if there is any receipt in kind and if it is otherwise covered by the definition of property, it might still be taxed, but otherwise This would not be. And coming back to something which I emphasized in the beginning is that if it is any sum of money, it has to be coupled with another condition which will have to be satisfied, that it was without consideration, which will have to be satisfied by the assessing officer. Amit Jain's case was a case wherein the person who had received a loan from his HUF, and after having received a loan to his HUF directly from the HUF's bank account, had given a gift to his son for valid purposes. The department wanted to say that this is a gift from an HUF and therefore we will tax you in your hands. So these are just the cases within a short span of about a decade. Such bigger issues have arisen, and then I am placing before you. Company to company, for about 5 years, this was a famous lovable tax planning which was being adopted for larger transfer of or restructuring cases, wherein one of the companies in a group would gift away the shares to another company. And this is something, it had the blessings of the few courts. I never agreed with that, but that had the blessings. Authority of advance ruling was against this, but these are the two cases wherein it was held. Some of them were Reliance related companies, she held that yes, there is no taxation. This was so in the context of 56(2)(7). Why I have singled them out today is that under 56(2)(10), it would no more be possible to enjoy some kind of a relief for the reason that 56(2)(10) now covers all persons, irrespective of whether AOP, whether company or whatnot. So whatever. So that is what it is. So this is the time of receipt. Isn't it that we have all been trained to decide that in which year the taxable event happened? Even though assuming that there was a receipt, the issue still would be that when can I be said to have received the money which is to be taxed? Is it that when I actually hold it, will it not be different in the context of the purchases? Will it not be different in the context of immobile properties? So though there is nothing direct available in the context of 56(2), I would believe that in respect of immobile property, it would be the possession which will be supreme. So if it is a possession coupled with an agreement of a TOPA kind, 53A kind, then in that case I should be alright. If not, on conveyance I could be said to have received. Then the issues would arise that in cases where I receive some property on live-in license, I receive some property on tenancy, I receive some property under a lease. Yeah, one would feel that, why am I talking about such things? These are events which should not attract tax, but these are the events which may attract tax, and therefore I am placing it before you that, it is not, as long as a lease is received which is that of a building or a land, then in that case you will surely have to apply your mind that the consideration which is moving for acquiring the lease, acquiring an immobile property of a defined nature under a lease which is moving is less than what was otherwise prescribed, then in that case there could be a chance. There could be a difficulty even in respect of tenancies for the reason that now stamp duty people in Maharashtra and in some other places have started valuing tenancy rights also. So unless your case is that tenancy rights are not land and building simpliciter but they are rights in immobile property, then you are safe. But if it is otherwise so treated, there could be a difficulty there too also. The important thing is about shares and securities. Will the receipt be complete on delivery along with the transfer form? As we have understood while understanding the term transfer under section 247, or will it be on credit to demat account? These are simple issues, but it is important to understand that what is the time of receipt, and that would define the year of receipt. In case of other things like jewelry, drawings, and I would take a view that they would be on possession. And unconditional possession is something which would be a better proposition. And the gift has to be completed, if at all, if it is a gift. Any sum of money, will spend a minute on this, is that a charge is in respect of any sum of money. Now, any sum of money, would it necessarily mean, and will the scope be restricted to tax alone, to cash alone? or it will bring in its fold something beyond cash? Will it bring in its fold something which is receivable? Will it bring in its fold something which is held in bank? Will it bring in its fold FDRs, which are deposits with banks? Will it bring in its fold the securities, which are otherwise transferable freely, by delivery? So will it therefore, in short, the magic would be to understand that is there a difference between cash and cash equivalent? The answer is yes. But is it that both are any sum of money? You will have to decide it. I, for reasons best known to me, is that of a view that any sum of money is not restricted to cash but is wider in its scope. And therefore anything which could be considered to be a cash equivalent would also be covered by that. Quite often it is seen that that somebody would tell you that look here, you are holding Kishan Vikas Patra, you are holding National Savings Certificate, and the person believes that a great tax planning is being suggested, and therefore one does it, advises the client to transfer the securities. This securities is also wide enough, but in such cases transfer the FDRs. So will it not be a case wherein that this could be considered as cash equivalent? There is also a possibility that if I have lent monies to my friend and the right to receive I give it to somebody else, which is otherwise encashable immediately on demand without demur, then in such case also there is a possibility that it could be treated as something which is any sum of money, a cash equivalent. So please look into that. But that without consideration benefit would always be to your help. The other principal issue which arises in this interpretation is, as I said, that for some unknown reasons, the legislature has provided that receipt of the following capital assets by the SSC. This would mean that, and that would alone be treated as a property. So therefore, not only there must be a receipt of a property, but such receipt should be that of a capital asset, and that also of the SSC. Now, why would you put so many barriers? I don't know. It would have been simple that receipt of any property, whether capital asset or as business asset, whichever it is, as long as you want to tax it, it would be taxed. And if it is otherwise fitting itself in the pigeonhole of section 28 or any other hole, then in that case 56 would not be attracted, is a position which is accepted by all of us. But for whatever reasons, some meaning will have to be given to it, unless you all are agreeable to treat these words as OTOs, which I would not want. So capital asset, so therefore this capital asset is, what is that capital asset? Is it the one which is of the nature which is defined in 214? The moment you say yes, you should agree with me that it would therefore exclude all those bonds, all those personal effects, even stock in trade, and importantly agricultural land. In lots of areas this planning is going around wherein you have been advised to give the agricultural land. Now therefore would you be in a position to rely on the definition of 214, or is it a capital asset which here is something which should carry its common meaning, that any asset which you otherwise are receiving is if it is a property, if it is an immobile property, it will be covered. I am personally of a view that section 2 subsection 14 has nothing to do with this, and whatever asset which you receive, if it is of a defined nature of a property, then in such case it will be covered. But other view is possible, and more possible for the reason that some meaning will have to be given to the words, and we have been trained to believe that when a term has not been defined in a particular provision, if it is defined elsewhere in the same enactment, then you take the meaning from that particular provision. So that is a possibility. And then also the issue which arises is in the hands of the SSC. Now the recipient would surely, if he is allowed to get out of the taxation, will hold it as a capital asset. So would it therefore be that that if you receive a capital stock in trade but you hold it as a capital asset, then in such case only the charge would be activated, and if you don't hold it as a capital asset, then in that case the charge would not be activated. Two views are possible. the special bench of Delhi Tribunal had stated that even when stock in trade is being transferred, at that particular moment when the stock is being received, at that moment there would be a momentary interregnum, and by virtue of which it would be treated as a capital asset. And if that decision is the correct decision, which has been delivered in a different context, in the context of 45(3). So whether that would have an application here or not, please apply your mind to it. Immovable property, now we'll have to move little faster. Primary issue which I am placing before you is that what is the true meaning of an immovable property here? Here it is so defined that immovable property being land and building, period. Therefore it should be treated as exhaustive. If an immovable property is not classified as land, not treated as a building, the charge should fail. That is the understanding. And this is something which we are familiar with because it has been interpreted now even by the high courts in the context of provisions of 50C, and therefore in that view of the matter it would be fair to conclude that for 56(2)(10) also it would not take in its compass the rights or interest in land and building. So lease should be out, a license should be out, or tenancy should be out. Even though there may be rights in respect of land and building, that should be out. That's the way one would look into this. Another aspect which you need to keep in mind as a matter of practice, routine practice, that for some reason the difference between the consideration which is moving and the stamp duty value is higher, then in that case you have a power to ask the assessing officer to make a reference to the departmental valuation officer. But as you have been cautioned time and again by the courts, the obligation would be yours to make an application for making a reference to DVO. In some cases the assessee had failed to do so and thereafter he had been punished for not having made the application. Important thing which we need to appreciate is there is a power with me to make an application and to prove that stamp duty valuation is much higher than the realistic value. So please use and enjoy your power. That was one part of this. These are the cases which are delivered in the context of 50CA. I did talk about lease and such other rights, but there is yet another right which arises on account of executing an agreement for purchase of a property, which is under construction. Then in such cases there is a right. Can such right be considered as land or building? The courts are saying that no, it should not be treated. It is a right capable of being specifically performed. You can insist on its performance, but it still is not a building. It's in respect of a building under construction. But the last decision in the Thane developers case, in the context of 50C, has taken a different view. While the later decision, Ahmedabad, is clear that it is only a right and 50C does not apply. So therefore there is a dichotomy possible here, so you'll have to have your own conclusion on that. With that we come to movables. Very specific provisions are made. The definition is exhaustive, though what is included is yet not defined, but property, movable property is defined, and what are they? Shares and securities, not defined but included. Jewelry, not defined but included. Archaeological collection, not defined. Sculptures, not defined. Drawings, paintings, works of art, not defined. Bullion is included, not defined. In this case, the charge is even when you receive something for inadequate consideration. Without consideration, there surely is a charge. But even when you receive something for inadequate consideration, there is a charge. Reference to DVO in cases of movable properties is not specifically given to you. Reference, power to make a reference to DVO, unlike immovable property, is not vested into you. And if you feel that, okay, there is a power, you will have to read it into the provision. You will have to read it. The better view would therefore would be that to, on your own volition, furnish a valuation report of a valuer of your choice. But please bring something on record to support, and simply don't just argue that yes, that this difference is not something which is properly calculated. Support it with some this thing. Then just by way of a routine exercise, I tried to think of some examples that whether they would fit into this definition or not of property. And some is business undertaking. If I were to gift a business undertaking to somebody, would it be covered? The answer appears to be no. If I were to gift cryptocurrencies, the answer appears to be no. If I were to do it for intangible assets or fixed assets which are not otherwise covered, the answer is no. Receivables, as I cautioned you, it could be covered. If somebody were to reimburse the expenses which otherwise were required to be incurred by me, will it be covered? And lots of other things, like somebody were to gift a vehicle, then in such case, would it be covered? These are the issues which are open issues, so you'll have to find your own answers. But my answer to that would be that none of these are covered, but for these receivables, because the movable properties for the purposes of 56(2) are exhaustively defined. These are computation provisions. The only thing which we have to take home is that for the purposes of deciding what is the amount that would be taxable and what would not be taxable, by exclusion up to on account of threshold is 50,000 in aggregate and not in respect of each of the transaction or the property. Consideration. This is good, see. Very important, and the heart of it is, heart of it is, as I said, is receipt, but the body of it is consideration. A receipt without consideration or for inadequate consideration is taxable. For a moment, just take out this inadequate consideration out of your mind so we can focus on it. What we are talking about is consideration. If for some reason, if you are able to establish that there is a consideration moving for the receipt, then in that case, the charge here may fail. The charge here, in spite of its audacity, may fail. So therefore, it's important to understand what is consideration. In a classical manner, once again, such an important thing is left undefined. And unfortunately, consideration is not something which is defined anywhere in Income Tax Act 2. So therefore, you will have to find your own meaning. So you have two alternatives. One is that, you provide the color to the term consideration, by referring to dictionary, by understanding how it is considered in common parlance. Or a safer view would be to understand it with some other, how it is defined in some other legislation. Let's at least for a moment try the other part of it, the later part of it. And the act which comes to our rescue is the Indian Contract Act. Indian Contract Act in section 2D provides a reasonable understanding of consideration. Consideration could be a promise to do something, or not to do something also could be a consideration. I will not sue you could also be a consideration. So this is just one of the simple example of it. And it works in all three tenses. I could have done something, I could not have done something in the past. I would do something presently, I will not do something presently is also a consideration. I promise to do something in future, I promise not to do something in future is also a consideration. But the sum and substance and the most important element of any contract is moving of a consideration. 2D in very unclear words say that a contract in which a consideration is not in existence is a void contract. Not even a voidable contract, a void contract. It's to begin with, it is null and void. And therefore it is not enforceable. Are we talking about that consideration? Immediately, in our mind would come that, then if that is so, what about these gifts? See how they are valid, how they are enforceable. So, Indian Contract Act takes you to section 25. It provides about the exception to section 2D case. It lists down the cases wherein, even where the consideration of the kind which we discussed is not moving, exceptions are provided, and one of the exceptions is that when a person has agreed to give something or has given something or had given something by natural love and affection which a person bears toward that person, then in such case, and if the person is otherwise related, then in that case the gift is something which is enforceable in law. It would not be a contract without consideration. This is what it is saying. But mind you, this exception says that it would not be void. It does not convert a no consideration into consideration. It would still be a no consideration case, but it would not be void contract. That is the only thing which we need to keep in mind. So if one is allowed to sail with this understanding of supplied by Indian Contract Act, then in such case everything will have to stand the touchstone test of the Indian Contract Act in order to establish that whether there is a consideration moving or not. And trust me, other than gifts, which we have said that is otherwise also not void, then because it's covered by exception, then in such cases Indian Contract Act should healthily come to your rescue to establish that there was some consideration moving. And if some consideration was moving, then in such cases I am afraid the charge of 56(2) would fail in most of the cases, unless it is a case of inadequate consideration. Then in that case you will have to get into the formula mathematics of calculating it. I'm just listing down few of the cases wherein there may be consideration or it may not be, so you will have to decide. There are cases of admission and retirement from the partnership firm. There could be cases of realignment of the profit sharing ratios, restructuring the profit sharing ratios. There could be cases wherein you receive something by way of an ex gratia, you receive something by way of an insurance claim or alimony. What I am putting before you is that are these the cases in which some consideration is moving, and whether can you supply a consideration in the context of what I placed before you are the questions which I am putting before you. I am being given something for my personal qualities. Will it be for a consideration? You have famous Mayawati's case who had been given crores of rupees in addition to the big garland also. So what the courts have decided before 56(2) came in force? Natural law, would it be a case of consideration? Employee stock options, are these the cases of consideration? If they are not, it can be taxed here. Partition of HUF, if there is self-impression, is HUF taxable? Distribution and disbursements. Shareholders receives all kinds of receipts, rights entitlements, bonus, conversions, convertible bonds, and so on. In such cases also, is there a receipt? Is there a consideration moving? So let's very hurriedly, go through some of the decided cases which have examined what is a receipt, what is a consideration, and what is a charge under 56(2). These are the three things which have been decided. Yes. Yeah. Parvez Poonawala, all of you know that he is a famous panelist. Every day you see his face on the media channels, and in his case, he had given up a right, to contest a will. He had given up a right to contest a will. He could have asked for his share in the inheritance of some of his ancestors, but he did not claim. And for that, he was rewarded with a very handsome amount. The issue arose that whether 56(2)(10) applied, 56(2)(7) applied, or earlier provisions. The Mumbai Tribunal stated that when he gave up a right, a consideration moved in favor of the another person. So a right was a valuable right which he had given up. So the amount which he had received was for a consideration, very beautifully held. So this is one example of it. The classic and the common example, the judge mentioned in the morning, is that there are lots of family disputes, lots of divorce cases being filed. And obviously the divorce has to be followed by some payments, alimonies also. So these are the cases in which it was decided, because the AO had to, inflict more trouble on the lady, stating that what you have received from your husband by way of an alimony is taxable. Fortunately, the tribunal said that nothing doing, it is for a consideration and therefore not taxable. But such things happen. In the morning, somebody told me that, that you will have to specifically refer to family settlement and what happens to this is. Paras Gundecha's case is the one which examined the implications of 56(2) in the context of family settlement, to hold and correctly hold that in cases where family settlement held, subject to one caveat, that they are genuine family settlements. If they are so, then in that case I would be of a view, so has been the tribunal, that it would be not attracting 56(2). Abhinav Bindra, famous medalist from Olympic, in his case the award which he had received was sought to be taxed under 56(2). Unfortunately, Delhi Tribunal and now High Court also confirmed that it is not taxable. I received something on dissolution of a trust which I am a beneficiary. Will that amount also be considered as a receipt? An interesting aspect of it. Is there a consideration moving on account of this? The tribunal tested this particular aspect and came to a correct conclusion that it is not. Though tribunal did not, in detail examine whether a consideration was made. But what perhaps prevailed with tribunal, and correctly so, was that whether there was a prior right to receive or not. Whether there was a prior right to receive or not. And if there was a prior right to receive, you don't need to even look into the consideration aspect of it. That is yet another interesting aspect of the whole facet. When I receive something for personal qualities as my employee, now that in the scheme of taxation it might be taxed as salary is a different thing, but whether 56(2) would apply, and the answer here is no, because it is received by an employee. Now whether Mayawati would receive it and will it be taxed under 56(2) is a different question, but when an employee receives it, 56 is not the right platform. It could perhaps be under section 15 or 17. Then receipt of accident claims, though we do not have a direct decision under the Income Tax Act, but the National Commission, Consumers Commission had decided this issue, wherein it was asked to deliberate and adjudicate whether the receipt was liable to TDS or not, and it concluded that it was not liable to TDS, whether it was within its power or not. So these are the few cases of consideration. Continuing with it is, a beneficiary received some money. A beneficiary received some money from a trust, and also a trust received some money, from a settler. And we have earlier concluded that a receipt by beneficiary may not be taxable because of Ashok Pratap's case. This was a case in which it was also decided that it is not taxable, but it was also asked to decide whether the trust would be taxable on account of the money which the settler has put. You all are aware that these are the famous issues wherein estate planning is being happening all around the transfer of funds or the transfer of shares to the trust in settlement. So here the issue was whether the trust was taxable, and the Delhi Tribunal stated that the trust was taxed in the status of an AOP, and therefore in that view of the matter, because at that point of a charge there was no charge on AOP, it would not be taxable. Would the answer be different? I would believe that the decision itself had not perhaps been delivered on the right tenets of the law. It should have very clearly stated that it is for a consideration and not because it was an AOP. A trust, as you are aware, that could have been taxed in the status of an individual also. Perhaps to be taxed in the status of an AOP itself is something which is not acceptable to the mind. But that is something I am just placing before you. When a partner is being admitted, you have a Supreme Court decision which says that it is for a consideration. It is for a consideration, and that view of the matter 56(2) should not apply. And the issues of inadequate consideration should not trouble you because it's not a specific charge. Similarly, the same would be in the case of retirement. Retirement has been recently examined in the context of 56(2), and therefore is a better proposition that it is not attracted. Of course, these are all tribunal decisions, will have to stand the test of the higher courts. Receipt by a power of attorney holder is for a consideration to act as an attorney, and is for doing something for and on behalf of somebody. Even in such cases, repetitively such receipts are being brought to tax, which later on don't succeed. So this is a classic case. In Shah Rukh Khan's case, he has received a villa, in somewhere in Sharjah or Dubai, and the issue was whether it was a business receipt and whether taxable. If not under 28, at least under 56(2), the charge had failed because at that particular time the charge did not succeed. Now today what would be the fate of it? If it is a business receipt in the course of business, there is no problem. But if it is for personal business reasons, then in that case, the charge would now succeed in his case. We have talked about this. Then receipts for shareholders, we will very quickly rush through that because this is the one single class which is very important, and it's important to understand what is the taxability of it is. So when I receive a right entitlement from a company, the special bench in this case stated that it is for a pre-existing right. It could have also stated that it is also for a consideration and therefore the charge would fail. Correct decision, but the reasons could have been better. Same is in the context of bonus. There is a pre-existing right. There is something which I am receiving. Buyback is an interesting thing which has been recently concluded or cracked by one of the benches of the Mumbai tribunal. I would have believed it could have expanded. What it says is, it's not dealing with receipt or consideration. It simply states that on buyback of a share of a company, what is envisaged in order for a charge to be successful is you should have been receiving shares of some other company. When you receive shares of your own company, the question of application of 56(2) does not arise. Reason could be right because the shares would be extinguished. The shares would be extinguished and therefore the company would, after buyback, after the process of extinguishment, would not hold anything. But the better thing would have been that it was for a consideration and therefore in that case, but we are safe. But the issues which have yet to be cracked and concluded, but which otherwise are all cases but for one, are the cases of issues for consideration. Receipts for consideration and should not be. That's on conversion of debts by a company, that is initially some debentures are issued, thereafter they are converted into shares, it is for a consideration. Reduction of a capital, I have a pre-existing right, 56(2) should not apply. On liquidation, I have a pre-existing right to share in liquidation, it should not apply. On amalgamation or demerger, in both cases, I am holder of shares. There is a consideration moving for agreeing to amalgamation and demerger and therefore should not apply. On conversion of a firm into company, after introduction of 50CA, as far as firm to a company, perhaps you are receiving shares. But when it is other way around, when company is being converted into an LLP, your shares are being extinguished. And after introduction of 50CA, if you are a non-compliant 4713B situation, there would be a lurking danger in terms of application of 50CA. Time permitting, I will take you through that. Right entitlement, preferential entitlement, all cases of consideration. Shares at a discount, you will have to establish that it was for a consideration and it was adequately priced. If not, it could be treated as for inadequate consideration and there could be trouble. Stock option is one last example which surely is for a consideration, and that being employment. Then in all cases of inadequate consideration and cases of without consideration of property cases, you are asked to work out what is the fair market value. You are asked to work out what is a fair market value. As far as immovable property is concerned, you are simply told that you get it valued by adopting the stamp duty rates which are adopted by the stamp valuation authorities, period. And this is something all of us are very familiar with. But the other part, when it comes to valuation of the properties other than immovable property, we need to understand it a little in detail. So there are three classes mainly. One is shares, the other one is securities, and the third one is all this jewelry and the second one is jewelry and the third one is all these archaeological collections. So as far as jewelry and these collections and works of art are concerned, there are simple formulas that if you have purchased something from a registered dealer, then whatever is the invoice value is the acceptable value. And if you have paid for that, there is no liability to pay any tax under 56(2). Simple. If you have not purchased something, then whatever is the value which would fetch when sold in the open market, then that would be the value and you should adopt that. If it is a mode, that is the third mode other than the first two mode, then in such case you might obtain a valuer's report and substantiate the value by saying that I have paid the full consideration. Simple rules. When it comes to shares and securities, the important rule is 11UA and 11UAA. So this is something, see, if time permits, we will discuss about it in detail. But what is important is that you are provided with. Yes, the idea is that we have begun a little late, and that's why I might have repeated that time permitting. It's not that I do not have the desire to share it with you, but time permitting, chairman permitting, we will discuss this. There already is a movement of people for right reasons, so we will see whether it's possible or not. So these valuation rules are very important. Keep that in mind. Simple formulas are provided, which I would surely share with you. And what are those formulas? We will discuss about it a little later. But before that, in order to be comprehensive on the subject which we are discussing, let's suppose that what are the receipts which are exempted specifically, and there are 10 such receipts. What are they? If you have received it from an individual, if you are an individual and if you have received it from another individual, if you are an HUF and if you have received it from a member, and if that person happens to be a relative, of an individual, it would be out. If you have received something on occasion of a marriage of an individual, then in that case, it would not be. If you receive something under will, irrespective of your relationship, or if you have received something by way of inheritance, it would not be taxable. If you receive something from a person who is contemplating, who is on a deathbed, then in such case, if eventually the unforeseen event happens, then in that case it would be considered to be a gift in contemplation of death, and the gift would be conclusive. In such cases, perhaps it would not be taxed, even if it is from a person who is not your relative. If you have received something from a local authority which is defined, then it will not be taxable. If any of the entities which is referred to in 1023C, whether registered or not, then in that case it would not be. These are educational institutions, medical colleges, medical hospitals, such other things. Beautiful provisions. If you receive something from a charitable trust, which here has to be registered under 12A or 12AA, that would not be taxable. You may not be otherwise related. If the receipt is by any of the entities which are referred to in 1023C, it's a converse case. The institution is receiving, it would not be taxable, irrespective of the exemption or otherwise under 1023C. If there are specified 47 related transactions of amalgamation, demerger and such other things, holding subsidiary transactions, it should be outside the ambit of 56(2). What is added, and it is a matter of interest, is that if there is a trust which is settled by an individual for the benefit, for the sole benefit of the relative, and that happens to be a private trust, then in such case it would not be considered as a receipt which is taxable. Now what was happening is that before this insertion, which is effective from AY 1819 alone, there had been a reasonable view prevailing amongst the professionals that such a receipt was not taxable in the hands of the trustees at all. Such a receipt was not taxable in the hands of the trustees at all. Now that there is a specific provision which has been introduced, it is for the seniors to consider that would therefore be all that unless you satisfy the text of the amendment, in all other kinds of settlements of a private trust nature, the exemption would fail. This is something which had been recently tried in the context of HUF by Ahmedabad Tribunal. The Ahmedabad Tribunal, before the amendment in relation to HUF receipt, had without any hesitation held that a receipt by an HUF was not taxable. It had also held a receipt by a member was not taxable. But after the amendment, it held that because there is now a specific provision, unless all the terms and conditions of a specific provision is established, it would otherwise be taxable. Taking a clue from that decision and taking a color from that, it perhaps would be so that all other settlements, if they don't meet the test of the amendment, then in such cases, there is a danger of it being taxed. Just a view is possible, think of it. On the occasion of marriage of an individual was tested. This was a case wherein, on the occasion of the marriage of a daughter, the father was gifted. And the court said that, look here, if the daughter had received it gift, it would not have been taxed under this provision. Now there is a High Court decision validating this understanding. So what is exempted here is the person who is getting married and not the family members of the daughter or the person who is getting married. This is donatio mortis causa, that is contemplation of death. In Mohammedan law it is marzul maut, wherein these courts have examined that in what happens where subsequently the person survives the gift. In such cases, according to the general principles of law, the gift fails. If the gift fails, then according to me, charge can be activated if the amount is not returned. But as it has been so placed in 56(2)(10), it is possible to take a view that at the time of receipt, whether it was a gift in contemplation of a death, if it is so, irrespective of relationship, perhaps the charge would fail, possible view. Under a will or by way of inheritance, I am repeating this because here relation is not required. By way of inheritance is wider for the reason that in such cases, whether you had a prior right to receive, prior right to succeed to the estate of the deceased or not, in such case it would still be considered as by way of inheritance. If it is so established, then it would be outside the ambit of it. In relation to the rest, nothing important. The last bullet is important, which is a recent decision delivered by Chennai Tribunal, which had an occasion to examine the implication of 56(2)(7)(a), which is now no more of the threshold, which is now a part of 56(10). Chennai Tribunal in this case held something which is very unique. He said the tribunal stated that objective of 56(2) has been resting on the important aspect that in all other in cases where there was a tax evasion, there was an intention to evade tax, transfer wealth, then in such cases 56(2) might perhaps come to the rescue of the government of India. But where there is no avowed objective of tax evasion, the entire scheme of 56(2)(10) should fail. Whether this is a right decision, I would like to believe it is right, but whether it will withstand the test of the court, I believe not. But till such time, if you have troubles, you can surely rely on a single decision which is in favor, on the intention behind the receipt, receipts. Who are the relatives? All of us are aware. Broadly, they are spouse, they are brothers and sisters of the spouse, brothers and sisters of the individual, brothers and sisters of the parents. Then what also include is lineal ascendants and descendants, and importantly spouses of all these categories of persons. And lastly, an HUF receiving a gift from the members of the HUF. These are the persons who are otherwise covered. So let's understand a few things in respect of which no direct answer is available. It's been provided that lineal ascendants and descendants are excluded. So in determining my lineal descendants and my lineal ascendants, should I examine it through my daughter? Should I examine it through my mother? Can it go upwards through her branch? Can it go downwards to my daughter's branch? Or lineage is to be defined only qua the male persons, that is my son's lineage, my father's lineage. This is something, see, and this has, when you go into the general law, wonderful answers could be provided, please look into it. But for the purposes of Income Tax Act, way back Rajasthan High Court had an occasion to understand this provision and said that as far as Income Tax Act is concerned, it would work two ways, meaning females also would be included, and it would be in fitness of the things, considering today that we live in an era wherein females are equal to males, so therefore in such circumstances there should not be a difficulty, but there could be a question, and that's why it is placed for your consideration. Another important thing is to understand that my son-in-law, if I give him a gift, he would be my relative. But if my son-in-law were to give it to something back to me, then he may not be my relative, and it may not be examined. So what is emphasized is relationship for the purposes of 56(2) is not a two-way exercise. What is true one way need not necessarily be other way. So it is a one-way exercise. Other side there could be a no entry. You should keep in mind. Third is relationship should be examined qua the recipient. So when a my minor child is receiving a gift, his relationship should be examined with donor and not with me, even though the income thereof is being clubbed in my hands. My relationship with my brother may entitle me to claim exemption. But my son's relationship with my brother, if it is not a defined relationship, it will be taxing. So the relationship is to be tested before applying the provisions of section 64. Same is yet another case that my Mausi is a relative for me, but my Mausi's son is not a relative for me, though he is my cousin. So therefore this also one has to examine the relationship qua the payer and the recipient and nobody else. This is the case of Rajasthan High Court. I was referring it to. Time permitting, you may please look into that. Two-way relationship cases also are listed. Gift to HUF is really a pain in the neck, and you please apply your mind to all this. But what is paining me and troubling no bound is the last decision in the case of Subodh Gupta HUF, wherein the Kolkata Tribunal recently held that gift from a mother received by an HUF. Now today there is a specific mandate that if there is any receipt by an HUF from a member, it is not taxable. You don't need to fear. But what Kolkata High Court Tribunal says is a mother is not a member of an HUF. Now this is something, to me, is not something which is an acceptable proposition in law. A mother also is a member of an HUF, and after 2005, a daughter is not only a member but is also a co-partner. So therefore this is something, but you need to negotiate out of. We are all practitioners of tax. Whether it is right or otherwise, while advising, we have to take care of all these things. Because before we advise and tender a clean advice, if there is a problem, we have to caution the client about it. As far as adoption is concerned, an illegitimate son is concerned, a spouse is concerned, who is brother, a stepbrother, a stepsister, co-brother, all such issues, you need to keep one single decision of Supreme Court in the case of Kirtikan Vododaria before you. Ordinarily, you would believe that an adopted son is also a lineal descendant. But when you read these decisions, you perhaps might realize that that it may not be so simple. Mind you, have a definition of a child in section 215B of our Income Tax Act itself, which says that an adopted child also is a child. But when it comes to lineage, it perhaps can have a different view. And the recent two Supreme Court decisions, provide a good food for thought is that, today you are now permitted to have this same-sex marriage also. Now same-sex marriage, if they adopt a child, in such cases, what is the lineage? There will be a lineal ascendancy, descendancy, I don't know. Then today now Supreme Court also is approving the adultery also. Now it will therefore, the question of illegitimacy and such other issues also would arise. So these are the, offshoots, of the decisions of the Supreme Court, which will have to be kept in mind. Something which is quite often, used in order to explain, and it is also used to express the pain which a person, a tax practitioner undergoes. Yeah, I'll finish it. How much time you would give? 5 minutes. Okay, right, yes, yeah. Choice is absolutely yours. Yes, yeah, right. Yeah. So, this is that, in order to express what is the pain which a person undergoes, when he is faced with the difficulty of explaining the genuineness of a loan, as per provisions of section 68, before a defendant assessing officer. And the story goes like this. A tax practitioner was defending the case of an assessee who had taken loans from 100 persons, exactly 100 persons. And he was asked to bring the confirmation, and he furnished confirmations of all these persons. Then the assessing officer said that, who are these persons? He said, they are all my relatives. Is it so? Some of them appear to be, not your relatives. The person said that, okay, let's take one after another. Who is this person? He's my brother. Yeah, it seems to be so. He's carrying your surname, so should be your brother. Who is this brother? He is my cousin. May not be carrying my surname, but seems to be from my religion, so must be yours. So, assessing officer was allowing few things. Then he asked another person, who is he? He's my brother. The man said, look, he seems to be from a different religion. How could he be your brother? He said, he is my brother, please allow this. Then another person. He said, again, my sister. But this is not even that faith. Sir, she is my sister. Now this man banned his paperweight and said, you are taking me for a ride. Too much is too much, I will not accept this. Explain how many people could have been your brothers and sisters. So he said that, I'll share some secret with you. That, my father was not a man of very good habits. I'm sorry, he was not a man of very good habits. And I would not be surprised if you also turn out to be my brother. So therefore, this is what happens, when it comes to stepson, illegitimate son, daughter, even in spouse. What is spouse? Spouse is not defined. Spouse is not defined. And therefore, whether at the time of the transaction, whether the relationship should have subsisted or not. If it is not subsisting at that particular time, because most of us follow a faith which does not require an agreement or a contract, and many of us may not be registering the marriage. In such cases, the issue arises that how do you establish that a person is your spouse? So, and especially in cases where the relationship has been stringent and has led to separation, which is yet to be regularized by the court. In all such cases, the issues would arise. Fortunately, you have 49(4) that on whatever amount you have been taxed, in case if you transfer that property at a later point of time, in computing your capital gains, you would have a right to substitute that fair market value as your cost of acquisition, and to that extent, it will suppress your liability for taxation in the event of transfer. Receipt on issue of shares is something within, this is a different charge, 5627B, which provides, this is something I'll discuss and then sit down. 5627B is a charge wherein a company which is issuing shares of the shareholder, it would be taxed in the hands of the company. And beautiful methodology has been provided that how to determine the fair market value of this 1500 rupees and then how to bring it to tax in the hands of the company. In this case, no tolerance band has been provided of 5% in such case. Methodology has been provided in the form of 11U, 11UAA and 11UA. These are the three provisions in respect of which it would be so doing. I had also set about to discuss with you that in the context of 56 to 10, if the valuations were to be made, how they were to be made under 11U. There are beautiful cases, all of them have been cited. Please take trouble to look into that. If none of them could make sense to you, do write to me and it would be my bounden duty to respond to that. My email also I will share with you. So don't worry about it, we will not leave anything incomplete. The last thing was about 50CA, which is a new animal which has come in, which now provides that if you were to transfer the shares of a closely held company CHC for a consideration which is less than, now this is reverse, in 5627B you were issuing shares for a consideration, which was much higher, right? How the law is trying to, engulf you from all angles. It's almost like a virtual strangulation. So here is a case where I am transferring something as a shareholder. Now it provides that and if the shares are that of a closely held company, whosoever is the buyer, then in that case it will have to be valued in accordance with the rules provided. And what was happening up to 17, 18 was a very simple thing. Book value calculations of the net worth was determined. It was divided by the number of shares. Now the whole thing has been changed in respect of the shares and securities, in respect of immovable properties held by the company, in respect of jewelry held by the company, in respect of archaeological collections, and in respect of works of art held by the company whose shares are being valued. You will have to substitute it with the market value, and thereafter determine the value of the shares which you have transferred. So the methodologies which were so far available for transfer of big funds, GIFTs was the case of a transfer of small funds. Methodology which was otherwise available to the companies, to the high net worth individuals, are all sought to be blocked in one manner or another. So now the presumption should be that anything and everything which I receive in some manner would be taxed. And therefore you should start with that before you conclude that it is not taxable, but do undergo the exercise. With that, I am extremely thankful to all of you for having given me a patient hearing, to my chairman, for having given the permission to keep on talking and talking. In the end, permit me to share something which recently happened. Is that all of us are aware that that Imran Khan has now been elected as the president of Pakistan. Prime Minister, sorry. This is the mistake I do. Yeah, right. So he has been appointed as a Prime Minister of Pakistan, and he, somehow has a feeling that that he is an all-important person as far as Pakistan is concerned, and he has, of course, a mandate behind it. So he keeps on talking about himself. So he goes gaga over that, yes, that I am an important person. So keeps around taking rounds and all that, and lots of people, cheer him up, and he is happy about it. And keeps on telling all this to his cronies who were at times fed up with all his, self-aggrandizement. So one day he said that let's go to the area where all embassies are located. So he took his cronies to the embassies where all these embassies were located. And there were lots of people, all standing in queues for taking visas. So he said, so look, in few days, I've made my country so prosperous that everybody can afford to go on a world tour, foreign trips and all such things. This really, rubbed his cronies. They felt that this is too much, but they couldn't speak much. So it's all right. He went a step further and went to one of the counters of the embassies, foreign embassies. And it so happened that everybody moved away. Everybody vanished. So he said, look, again, he was in his own dreams. He said, everybody respects me so much so that, everybody made way for me. This time his friends couldn't resist, and they said that, sir, that's not the story. The story is that everybody realized that if Imran Khan is leaving Pakistan and is applying for visa, there is no need for rest of them to go. So that's the reason I am also going away from it. Thank you, sir.
Thank you so much, sir, for that wonderful intervention into the subject. I invite our chairman for the concluding remarks.
Friends, we had some time for concluding remark and thereafter questions and answers. Purposefully, I thought that C.A. Pradip should speak what he has prepared, because that will cover all the questions and answers. And when I was looking to the front chairs, the seniors sitting here, and they were looking to the screen, and very with attention they have been hearing, I could realize he's talking great sense. Is what we all can. Therefore, friends, the time is 1 o'clock, so far the lunch was concerned, and 1:45 is the second session. So, I will not like to take your time. I hope we had enough of it. If we can digest what Mr. Kapasi had said, that will be a great thing for us, because he talked a lot of sense and lot of thoughts he has given us in a very, very short time. Thank you, Mr. Kapasi, for saying so. Thank you.
Thank you so much, sir. As a token of remembrance, I would invite Shri Arvind Ramani, PPA, to present a memento to our chairman, Shri S K Poddar, sir. Present a memento to the speaker of this session, Shri C.A. Pradip Kapasi. I will call upon Shri Hari Dudani, Secretary Tax Friends, to do the honors. Thank you so much, sir. Now is the time for the lucky draw. I would call Shri Salil Loda to help our chairman and the speaker of this session to pick up the lucky winner of this session. Please do the honor, sir. Please pick up one name. Number, yes? Name.
आप आगे बैठे तो उनको क्या देखने का? You are covering everything.
Lucky draw coupon number 66.
So here is the first winner with a great round of applause. Congratulations, sir. Can I request our speaker, sir, to pick up yet another winner, please, sir?
This is number 8. Number 8.
What about the flexibility of the receipt?
The person is not This is number 20. 20.
So our second winner of this session is here. Congratulations, sir. To of this session, I invite Shri Salil Lodha, and before that, a special announcement, if you permit me. For the lunch break, the arrangement has been made that for pure veg and Jain food is available at the coffee shop near the reception, and for the non-veg and veg lunch, it's available at the Accord on the 3rd. And now over to Shri Salil Lodha for
Respected Poddar sir, my colleague Arvind, Hari, seniors in the profession and friends. कहते हैं प्रतिभाएं प्रेरणाओं की मोहताज नहीं होती, प्रतिभाएं स्वयं अपना दीपक लेकर चलती है, अंधकार में प्रकाश का आह्वान करती है, और ऐसे ही अद्भुत प्रतिभा का नाम है प्रदीप कपासी, जिन्होंने आज के इस ज्वलंत विषय को, जो गिफ्ट के माध्यम से पैसा, प्रॉपर्टी या शेयर्स मिलते हैं, उसका कैसे टैक्स का आकलन किया जाए, उस विषय को बहुत अच्छी तरह से आपने विवेचन किया, जिसका आंसर 20 साल से गवर्नमेंट नहीं दे पाई, आपने उसका आंसर दिया। मैं प्रदीप भाई के लिए सबसे निवेदन करूंगा, एक बार जोरदार तालियों से आभार व्यक्त करता हूँ प्रदीप भाई। मैं आभार व्यक्त करता हूँ हमारे चेयरमैन सर एस के पोद्दार सर का, जिनका स्वास्थ्य अनुकूल न होने के बावजूद भी आज इस सेशन को आपने चेयर किया और वैल्यूबल गाइडेंस दिया। मैं आभार व्यक्त करता हूँ मेरे दोनों साथी हरि और अरविंद का एवं आप सभी का जो इस सेशन में उपस्थित है। धन्यवाद।
One more announcement. The price of the publication which was released today is 750, but for the delegates it is available at ₹500. And the book, A Fine Balance, Law, Practice, Procedure and Conventions, the original price is 1,250, but for the delegates it is available at ₹1,000 at the counters. Please enjoy your lunch, and we will ensure that we come back after 45 minutes. Thank you.